Hey, how's it going, guys? Derek Afasi here. Today's video is meant for the individual that's nearing age 60 and they're looking to cash out their IRA accounts that they've accumulated. So, really, I'm going to cover four main areas that every individual that has an IRA should be mindful of, especially if they're nearing this age 60 marker. First off, what are the purposes of doing this sort of withdrawal, and then making sure that you're segmenting, you're optimizing specific areas that are going to be a benefit for your ultimate retirement goal, whether that be income related planning and trying to maximize your income goal, your growth related goal, your estate planning goal, or your tax planning goal, how to make sure that you are being most effective and most efficient in those different areas. So the most important question you should be asking yourself is, what is the purpose for this account? What is the purpose to make this sort of move? If it's not going to benefit you, then maybe you should not be trying to cash out the dollars from your IRA account. Your IRA account is a type of retirement account that you place savings into, whether that's you took monies from your old 401k account and you rolled it over into an IRA, or you made contributions into your IRA as you were also making contributions to your employer plan. So you basically have this bucket that's sitting there. Now, whether this is a traditional IRA, which are qualified pre-tax monies, or it's a Roth IRA, that's going to be a large difference on how you would leverage these dollars towards your four main areas. Really, the areas that you should really be looking at to optimize the most effectively. So to repeat those four main areas, what's your distribution planning need for these dollars to make this move? Is it going to put you in a better situation? Do you have an investment planning need for this? Do you have a estate planning need, or do you have a tax planning need? So with distribution planning, some of the most important, I guess, bullet points that we want to go over, that we typically go over with individuals, is what is your ideal retirement date? If you're looking to trigger these monies or pull out these monies or leverage these monies at age 60, what is your ideal retirement date for an income purpose where you want to essentially stop working or have a significant decrease in working with your current occupation or trying to bring in income from your current occupation? What's that date that now you have to rely on your savings and your retirement sources to accomplish what your expense need is? The second most important area of this distribution planning need is understanding what are those income sources and doing an inventory of what you're going to be receiving of income in retirement versus what your expenses are. So get very detailed on what's the number that you have to hit from an expense standpoint. Because if you do not plan that out properly, you just are walking into retirement because you said, hey, I grew this IRA account into a pretty large amount and I feel like I have enough to retire now. Well, you're just leaving everything to chance at that point. You're not actually creating a plan. You're just looking at a specific number. So how do you make sure to dissect what is your actual need, what is your expense need throughout retirement, and then look at what your specific situation is that you could start to decrease those expenses and say, case in point, I have Social Security income coming to me at age 62 or age 65. This is when I want to trigger it. Also, I could trigger my pension income, and this is going to bring me X amount of dollars. Between the combination of those two, is there a specific gap there? If there's a gap there, based on when you want to ideally retire, what the ideal retirement date is, now you could create portions of a strategy, portions from your IRA account, and create that towards some sort of distribution or maximized distribution strategy, so that you're using the smallest dollars and only as much as necessary from that IRA. So the combination of your pension and your Social Security and any other sort of cash flows throughout retirement, the combination of all of these together could put you at a situation where you're receiving a retirement paycheck every month, and it's money that you could never outlive. Money that's going to go to you and your spouse because you created the proper strategy, the proper strategic plan. You didn't just leave everything to chance. Also, from a distribution planning standpoint, tax deferred versus tax free accounts. So you have IRA accounts that could be comprised of traditional IRAs, which are monies that are growing tax deferred, monies that you never paid tax on, so that when you're looking to take a withdrawal from that account, you're going to have to pay tax on those dollars. Why is that important? It's important because if you're taking any dollar out of that sort of traditional IRA account, you're not going to net the full amount of that dollar. It's all based on what your tax bracket is, what your tax rate is. So you have to incorporate that. If, let's say, you plan to receive income from your traditional IRA and you say, okay, I have a gap of $20,000, so I'm going to create an income strategy to produce me $20,000. If you did not incorporate the taxation on that, that $20,000 that you were taking withdrawals from, well, that might be closer to 15 or 17,000. So now you're having a shortfall of $3,000 to $5,000 for what you thought was going to be justified, or what you thought was going to be enough to produce you that type of cash flow. As opposed to if you accumulated monies in Roth IRA accounts, whenever you're taking distributions from Roth IRA accounts, those monies are going to come to you tax-free. So if you're looking at the difference between a traditional IRA versus a Roth IRA, and let's say you decide to take $100,000 out of your traditional IRA and only $90,000 out of your Roth IRA, even though the Roth IRA seemed like it was going to be a smaller number, you're able to net that full $90,000, if all other things being equal. The $100,000, if let's say you're in a 30% tax bracket, you have to give 30% back to taxes, you're only going to be able to net $70,000 out of that $100,000, withdrawal distribution. So that's a huge difference. Also, the impact on how this IRA could affect your Social Security income. With traditional IRA accounts, if you start pulling monies out and you're taking in the form of withdrawals and distributions, that's going to increase your provisional income calculation. What that means is that you could have a large portion of your Social Security income being taxed. So if you've ever seen the downfalls of Social Security and you ever heard of double taxation, what exactly does that mean? Well, individuals pay into the Social Security system. They do not get a tax deduction for when their paycheck is going towards that Social Security benefit. And then when it comes time to retire, if they do not set up their financial planning the correct way, they could pay up to 85% of that income that they're receiving from Social Security can be taxed. It's not going to be taxed up at the 85% marker, but it's going to be 85% of that benefit could be taxed at what that individual's tax bracket is. But if there's a way that you could make the proper transition points, figuring out what your ideal retirement date is, figuring out how much do you have in traditional IRAs, and if there's ways to segment dollars or convert them or create some sort of proper tax strategy on these monies, it could result in you receiving more tax-free income in retirement from these accounts, and then that tax-free income not affecting the amount of income that's going to increase your Social Security taxation. So case in point, you could be in a scenario where you're receiving Social Security income and you're receiving income from Roth IRA accounts, meaning that your Social Security income could be 100% tax-free, your Roth IRA could be 100% tax-free, and the combination of those two can be greater than or equal to your expenses. So now you have all your leftover monies that you did not use up from that age 60 marker to leverage it towards a distribution planning strategy. The second most important area that you should be mindful of and try to create some sort of strategic approach towards is if you're looking to leverage this IRA for some sort of growth need or investment planning need. Have a plan. Don't just leave it to chance. Don't just randomly throw it into, throw so much risk on it and just place it into one stock. Figure out what your risk tolerance is. Figure out what your time horizon is for these monies. What is the purpose of these monies? Why are you trying to grow, and for how long are you trying to grow these monies? Is there an additional need for it? Are you trying to grow this because you want to utilize it as a type of vacation fund? Are you trying to grow these monies to utilize it as a hedge against inflation? Are you trying to leave this account to beneficiaries and maximize that portion? What's really the purpose of these monies? So understand time horizon. Also understand the difference between volatility versus consistency. There's many times that individuals are always trying to chase that average rate of return, but if it's not consistent, that could completely blow up in your face, especially if you're trying to actually take distributions from that sort of account. Also, understand what your fees are. Typically, you'd have advisors that could charge anywhere between 1% to 2%. Be mindful that's a hole. If you think of your IRA account like a bucket, that's a hole coming out of the bottom of your bucket. That's a drag on your account. That's you trying to go fast, and a sale's basically holding you back is because it's dragging, it's draining from your account. If you add in different miscellaneous expenses, different fund-related fees that could be upwards of 1%, 1.5%, 2%, those are adding further negatives, further holes to your bucket. Are those fees justified? Understand and really do an analysis off of what is your current situation, what is the standard deviation on your current investments, and then more importantly, what are the fees on your current investments? And then, what is really the need for this? So I know I kind of mentioned it, but your ancillary need, is this for an ancillary need, or are you really trying to hit a specific number for a specific purpose? What is the method behind the madness to try to grow these monies in this investment planning strategy? And really, the investment planning is meant for the fund monies. As long as you have your income planning need and your distribution planning set up on a correct basis, then you could move on to that step 2, that investment planning need. If you do not have income, then you do not have, if you do not have income in retirement, then you don't have a retirement. So you always want to make sure that you're creating that baseline. You're building your house on rock first before you're moving into some of the fun stuff. Always want to have that safety net in place. And that's why distribution planning is so important. But the investment planning, if you cover your distribution planning, it makes the investment planning so much easier to deal with. You could leverage a combination of different things and say, okay, I'm going to segment these portions of dollars to be super aggressive. I'm going to segment these portions of dollars to be, to leverage what the current fixed rate environment is. I could leverage these portions of dollars to be more moderate. So there's a whole slew of different ways you could chop up, that piece of the pie from your IRA account and make sure that it's diversified and it's consistent as opposed to all over the place and you're just hoping that it's going to get to a specific number. Actually have a plan in place and get it, earmark what that, what that specific situation or what that goal is, so that you can correct everything, make the tweaks properly, and put you on that destination for success. The third important area is estate planning. And estate planning can be summed up in a very simplistic term. Do you want to leave monies to beneficiaries, to your loved ones? Do you want to leave it to charity? And if so, do you want to control how that's left upon your death? If any of those two questions are yes, well, then you should create some sort of estate plan. And that could be something as simple as just making sure that you have transfer of death on all of your different accounts, that you have beneficiaries created on all your different accounts, such as your IRA. There's many times that individuals, they have poor or no estate plan. And they say, okay, I'm going to, put this on my child. And I'm going to make sure that, the oldest of the children are going to control what the rest of my, what the rest of my kids are going to get. And then you'll hear those nightmare scenarios where the daughter takes the money because mom or dad left her all the inheritance and she basically flies the coop. She did not leave anything to the other brothers and sisters, and there's nothing that they could do about it because that individual did not have the proper estate plan they trusted. Same thing, you might have a step parent that comes in and the biological father wants to leave monies to their biological daughter or son or the children, and the step parent that this individual got their second marriage later on in life, and the step parent comes in there, and because he or she is eligible to receive all those monies, and they swore to that individual on their deathbed, yep, I'm going to make sure I'm going to do the right thing, and all of a sudden when push comes to shove, that individual takes all the money. So this is something that's not uncommon. You want to make sure that if you're trying to create specific strategies or you're leveraging these dollars, IRA monies, for some sort of estate planning need, that you're segmenting it properly. That if inheritance maximization is an important area in your planning need, well, then how do you make sure that you maximize out this inheritance? There's different ways you could do IRA optimization strategies where you could take portions of IRAs, you could take distributions from those portions, have those distributions purchase things that will magnify tax-free death benefits, such as life insurance aspects. So you could go and trigger lifetime income streams on your IRA, have that lifetime income stream pay for a life insurance policy, and now you're taking a $100,000 account and 5 timesing that with tax-free benefits to a beneficiary, because this $100,000 was you never wanted to use it up on during your own life anyways. You wanted to leverage this as a type of inheritance maximization. So there's so many different ways that you could do this. And the most common question that we get or that we try to uncover during our planning process is, or really take a step back, what I always think about with myself and my own family is, are we okay? Are me and my spouse okay? Is she going to be okay? And then are they going to be okay? My 3 kids, are they going to be okay whenever something happens to me? Some individuals, they might be completely fine saying, hey, listen, I don't care at all to leave an inheritance to my beneficiaries. I want to just make sure that the day that I die, I have nothing left in my name. And that's completely fine. Somebody regarding that mindset, estate planning will not be an important area of their financial planning need or for their IRA at age 60 marker. But for other individuals that do want to make sure they're leaving that legacy, that they want to make sure that they're okay, that their spouse is okay, that their children, their grandchildren are okay, or they're leaving some sort of legacy on that, that's where estate planning could be very important towards these IRA accounts and making sure that you're maximizing those dollars out properly. Are the dollars going to go to my beneficiaries taxable? Is there ways that I could make them tax-free to my beneficiaries? What's the projection on what this money is going to be to my beneficiaries, upon my death, if I feel like I'm going to live to my 70s, my 80s, my 90s? How are required minimum distributions going to affect what I'm leaving to my beneficiaries? So all these different things come into play to make sure that you could really maximize out that inheritance. But once again, if it's not important, then you should not try to optimize this area. Only go into the lanes that are most important and focus in on those key areas. So the fourth most important area that is crucial for you to understand is knowing that if you hit retirement and you have monies in an IRA, you have a new partner that's going to join your family on those dollars. And that person's name is Uncle Sam. The government is going to take their tax. They're going to take their money from that sort of account. If you're trying to defer those monies, they're going to take it when you start taking required minimum distributions from this account. Anytime you take a withdrawal from a traditional IRA, it's a tax deferred account, meaning that you've been deferring the taxes. So when you take a distribution out, you have to pay full taxes on those monies. The important thing is to take an inventory of all your accounts. So if you're trying to leverage an IRA for retirement planning purposes, are all these monies in traditional IRAs, are they Roth IRAs? If it's age 60, does it make sense to take out portions of your traditional IRA? If let's say you still have a couple of years before retirement, can you do conversions into Roth IRAs? What sort of tax hit will that be by taking the conversions on what sort of year? Does it make sense to take lump sum conversions and convert the dollars in lump sum? Or should you be very systematic with those distributions and with those conversions? So maybe an individual has $500,000 that's sitting in an IRA account and they're age 60 and they want to retire at age 65. Does it make sense for them to take $500,000 and convert it all in 1 year, or to take out $100,000 increments and convert $100,000 a piece each year for these next 5 years? What is going to be the most effective area to stay within your current tax bracket, make sure you're not shooting yourself in the foot, so that when it comes time that you're riding off into the sunset, that you're able to properly retire, you're able to receive as much tax-free money and have the least amount of dollars going to required minimum distributions, the most amount of dollars going to you for income, the most amount of dollars going to you for growth, and inheritance maximization. All those different factors come into play. Very important, be proactive now to benefit later. Don't just sit there and say, okay, well, whenever I retire, I hope that it's going to work. Because what happens many times is when somebody starts nearing their 60s, maybe they have their mortgage already paid off. And even though they're not looking to retire for another 3, 5, 7 years, their income for their current occupation is typically higher than what their expenses are. So that might be the perfect opportunity to leverage Roth conversions. When you're saying, hey, I'm already making all this extra money, as opposed to me placing those dollars and keep stacking away in my savings, my checking account, let me utilize these ancillary dollars that I'm getting left over with my income versus what my expenses are as I'm still working. Let me use that large chunk to pay off what my conversion tax will be when I'm converting my monies from my traditional IRA to Roth IRA. So when you fast forward to that age 65, 67 marker, an individual could have a large portion of their traditional IRA because they were proactive with their approach beforehand. They could have those monies now sitting in tax-free accounts as opposed to being subject to those taxable, tax-deferred traditional IRA accounts. So look at conversions, how to optimize conversion opportunities. If let's say you do not have any monies in Roth accounts or any tax-free related accounts, how could you make sure that you're segmenting contributions toward those accounts? So maybe if you only have 3 to 10 years to do contributions into that account, make sure that you're not contributing to those tax-deferred accounts anymore. If it's more effective to place monies and contribute into tax-free areas, and you're eligible to place those dollars into those tax-free areas. Something as simple as placing dollars into your Roth 401k if you're offered a Roth 401k. How to make sure you're maximizing that out. And then also withdrawals. If you're taking out withdrawals at age 60, how to make sure you're doing it on an effective basis so that it's going to be the least amount of taxation on your account and you're staying underneath specific tax bracket cusps. So I just mentioned the 4 main areas, the 4 most important areas that an individual that has an IRA account and looking to take distributions from this IRA or leverage this IRA effectively around that age 60 marker. What are the solutions behind it, though? Obviously, I just gave you a couple of different examples here and there. At the end of the day, look at the problem areas. Do you have a current distribution plan? Do you have a plan for your distribution? If not, that's probably a problem. Correct that area. Create a plan in that area for distribution needs. If you do not have more than enough income when you stop working that is greater than or equal to your expenses, you don't even know how to start that process, well then you should correct it. You should make sure that you're creating a specific plan. Investment strategy. If you have no investment strategy, you just say, okay, well, I think that this might be the right thing. I'm kind of sitting to some target date funds and I hope everything's going to work out. Hoping is not planning. Make sure that you have an effective strategy. That's obviously a problem area. So then how do you correct the problem? Be efficient. Create a plan for that. Estate planning. If you do want to leave monies to beneficiaries and you want to control how that money gets left out to which beneficiary, that's where you would create a proper estate plan on these IRAs. And then tax planning. Are you just sitting, do an inventory? Are you just sitting in traditional IRA accounts? Do you have any portions in Roth IRA accounts? Are you interested in how you can convert that properly, or how you can take your traditional IRAs and turn them into tax-free IRAs? What exactly is that whole process? So that's where it really comes down to three main areas. Is there a problem? Which area out of those four main areas is the problem? Correct that problem area, and then implement a plan. Don't just look at a number. Don't just say, okay, my account is nice and fat, so I hope that everything's going to work out. Be systematic with everything. Create a plan, not just a portfolio. Be mindful of the four areas that I covered. Distribution stands for D. Investment stands for I. Estate planning stands for E. And tax planning stands for T. It's the retirement diet plan. We have a trademark process known as DIET. Some individuals are do-it-yourselfers. And that's fine. At least now you have a roadmap and you have an acronym to follow to say, this is how I could be more effective, more efficient with my plan. For the individuals that want to make sure that they're creating the proper strategies, making sure that they're not leaving things to chance, that's where I would recommend that you give our 1-800 number a call. It's 1-800-566-1002. Or if you want to schedule a specific phone call and reference this video, you would simply click on the calendar link that is displayed in the description of this video. So you just click on that link, schedule your preferred date and time, mention this video, this is the one that you watched, and you would be eligible for your free 20-minute strategy session phone call. I want to thank you very much for watching this video. Feel free to visit our website at fosseyfinancial.com or retiresharp.com. It both brings you to the same place. And make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most videos, to most updated videos. Thanks so much, guys.